So we've kind of established one thing, which is that you still believe in value investing. Why?
Well, our definition of value investing is figure out what a business is worth and pay a lot less. It has nothing to do with low price book, low price sales. That's what stocks are, ownership shares of businesses. They're not pieces of paper that bounce around that you put fancy Sharpe ratios or Sortino ratios or whatever. They're actually ownership shares of businesses. So our definition of value investing is value the business and try to buy it at a discount. So by definition, that should never go out of it should eventually
go
work.
Out of fashion. It should.
Yes, it can go out of fashion, but eventually it should work. Yes.
Now, value investing, of course, in principle, is active management.
Correct.
Do you believe that there's a role for passive products?
Oh, absolutely. I was asked to give a speech at Google last year, and I started it this way. I said, even Warren Buffett says that most people are better off just indexing. And I said, I agree with him. I didn't stop my lecture there. I said, but then again, Warren Buffett doesn't index, and neither do I. How come? And it's because the opportunity is there, if you know how to value businesses, which most people do not, to take advantage of the fact that the market is emotional over the short term often.
You have had some success, Joel, with a hybrid of passive and active management. You call it the Gotham Plus Index Fund. People refer to it by its acronym GINDEX, a ticker, if you will. Explain how it works.
Sure. So it's Gotham Index Plus, and it's precisely that. The problem with most the problem with most active management is to beat the market, you have to do something different than the market. That means your return,
definition.
Yes, so your returns are going to zig and zag differently. Most people don't know the underlying thesis behind each individual pick. What they see are returns, and that's what they follow. So when funds do well, people pile into them. When funds do badly, they pile out. So even if you're a good active manager and have a good long-term record, many people don't stay with you. I wrote a book called The Big Secret in 2011, and I always say it's still a big secret because no one bought that book. But in it was a bunch of studies. One talked about the best performing mutual fund for the decade I wrote in 2011 for 2000 to 2010. That fund was up 18% a year. The average investor in that fund averaged a dollar-weighted return of minus 11% per year. They took that 18% annual, and the market was flat. So winning by 18% a year, they lost by 11%. And the reason for that was really that every time the fund did well, people piled in. When it didn't do well, they piled out. Whether it was when the market was up, they piled in. When the market was down, they piled out. And that's what people do because that's all they know. They look in the rearview mirror and chase returns.
So how does Gotham Index Plus, if you will, get around that problem?
All right, so that's the big question, and it took some thinking. And one thing we did was compromise. So we said we're going to start with the index because.
By the way, that's an unusual term to be uttered by a money manager, compromise.
Well, if our goal is to help people get to the end goal, meaning saving money, the reason why Warren Buffett suggests people index is because they won't underperform or outperform, and it'll remove one other impediment to sticking with the investment. So we looked at that and said, look, we don't want to make the pain so bad that people leave. We want people to stay and capture our active premium. So we made some compromises. If you give us $1, we'll go out and recreate the S&P 500 bottoms up. That's how we start the portfolio. So you get the S&P return. But then we add our active stock picking. We go out and buy 90 cents more of our favorite S&P stocks, and we short 90 cents of our least favorite S&P stocks. So we have a 90 by 90 long-short overlay, buying our favorites, shorting our least favorites. All we have to do is our favorites have to beat our least favorites, and we'll be able to add to the return of the index. But we make some compromises. We keep the beta at 0. We balance the two portfolios so they don't get too out of whack.
You're 190% long for the most part, 90% short for the most part. You use a lot of leverage, 280% gross exposure.
Yes, pretty good deal for a mutual fund, yeah.
Right, but the cynic might look at it and say you've outperformed. So over the past 3 years, you've outperformed the S&P 500 by 7 percentage points. Now, the S&P 500 is up quite a lot, right, in the past 3 years, and certainly up a lot more in the past 10 years. Anybody would be happy beating the market. But again, the cynic would say if you'd taken that leverage and just put it on the S&P 500, you'd be up a whole lot more. So what's the counter to that?
Oh, sure. Well, we kept the same beta as the S&P, meaning the 90 by 90 long-short overlay has zero exposure to the market. So we're adding return without taking additional exposure to the market, which, if it had gone down, would have hurt you a lot. So that's one major difference. The other is that this has been probably the worst environment I can think of for a long-short manager, because the market's gone straight up without correction other than the last few months, which was very minor. So if you go straight up, and we're short what we call hope stocks, stocks trading at 50 or 100 times earnings. In a very hopeful environment, people get hopeful, and they like those hope stocks. And so for our longs, our out of favor stocks that are still gushing cash, huge returns on capital, to keep up and actually beat those hope stocks, that was a great performance for us, in my opinion.
Joel, we're talking about the S&P 500, large cap U.S. equities. If you look at the universe of U.S. equities, how fairly are they valued?
Right. Well, so we actually bottoms-up value all the stocks in the S&P 500 and weight them in the weights of the S&P 500. We can do that for the last 28 years. We have good data for that. And so we can contextualize where do we stand today. So where we stand today is in about the 15th percentile towards expensive, meaning the market's been cheaper 85% of the time during those 28 years, more expensive 15% of the time. Then we can go back and say, not a prediction, but just saying what's happened over the next year or two from these prices, this valuation level in the past. And what we've seen is the market up 3 to 5% over the next year, 8 to 10 over 2. That's subnormal, meaning the market's expensive. The market averaged about 10% returns during that whole period, but not negative. So that's nice to see. The all caps are a lot different story.
Meaning they are much more expensive.
Yes, the Russell 2000s in the second percentile have been cheaper 98% of the time over the 28 years. Expected returns -3 to -5% over the next year. So you really have to look at the individual stocks you're looking at. They're expensive, but there's still opportunities.
Joel, I want to thank you for spending time with us here.
Oh, my pleasure.
Good seeing you. Funny insights from one of the world's great value investors, Joel Greenblatt of Gotham Asset Management.